Hi guys, Brett Warren here, your trusted Brisbane resource, and today I'm joined by Mike Mortlock. How's things, Mike?
Very well, thanks Brett. Thanks for having me on.
No problems. Mike's with MCG Depreciation. He's helped a number of our clients with depreciation on their property, and there's been a number of changes at the 1st of July, and I'm actually surprised by how many people have been caught out and have been surprised by the changes. So the most common one, Mike, is the change to depreciation. Can you explain a little bit about that for our viewers today?
Yeah, sure. I guess a lot of people maybe haven't sort of been exposed to it because it hasn't applied to them as yet. So any property, a residential property that's exchanged after the 9th of May, which was budget night, it basically means that if you buy an existing property, there's no claim on the plant and equipment deductions. So that's things like carpets, blinds, kitchen appliances. If you're not the owner of that brand new, or you're actually paying for it yourself, so let's say you renovate a property, then you won't be able to claim it. So if you buy a 1-year-old house, a 10-year-old house, there's going to be no claim on those plant and equipment assets if you've exchanged after the 9th of May.
Yeah, wow, that's really interesting. So a lot of people either have to force to buy new or actually renovate to get that depreciation.
Yeah, I mean, we wouldn't recommend sort of purchasing a property based on a tax strategy, although it does happen. People go to accountants and say, I'm paying too much tax.
We've heard that as well.
Yeah, but yeah, essentially, if you were working in this perfect world where you're just wanting to avoid paying tax, then the best thing to do is buy a brand new property. Of course, that might not necessarily be the best investment. If you're not buying a brand new property, then you might be looking at something that you're completely renovating, in which case, if you pay for the carpet, you pay for the dishwasher, you'll still be able to claim those deductions.
Yeah, sure. And you also mentioned that look, even though you did purchase something that may be second-hand, that you can't claim that plant and equipment, there's still the building depreciation up to a certain point as well?
Exactly, yeah. So if the property commenced construction after the 16th of September 1987, then you're able to claim a 2.5% depreciation rate on the construction cost at the time that it was built.
Sure.
So in our analysis, we looked at 1,000 of our last depreciation schedules. We did this at about 9:30 on budget night.
Yeah, right.
Which was a lot of fun. and we found that pretty much 70% of the properties that we do are built after 1987, which was a nice surprise. Yeah. And then of the ones that were built prior to 1987, we found that around about 64% of them had a renovation or an extension or some reno works to an average value of about $39,000. So if you're looking at a property that's built prior to 87, then you need to be sort of looking for improvements or renovations, so you can still claim, like if you're updating your kitchen, you're going to have all the kitchen cabinetry, you might have the tiling, you might have gyprock, you'll still be able to claim those components. Okay. But the vast majority of these properties that we looked at were built after 87, so you're still getting that building claim.
Sure. So
if you've got $100,000 worth of building works, you're getting $2,500 of deductions each year from the date of construction for 40 years. So it's still a significant amount.
Yeah, absolutely. And look, that'll definitely fit a strategy such as ours, obviously, that works quite well, where you could actually buy an older type property, renovate it, cosmetic fit out and things like that. And that would bring depreciation back into play and reduce your holding costs somewhat. So that's still obviously working quite well too.
Yeah, absolutely. And cash flow is what it's all about, and the banks are pretty keen on making sure you've got serviceability. So if you can sort of see after tax that the property's not costing you as much, or is maybe putting some money back in your pocket, depreciation is a key part of helping to sort of cash flow that investment.
Yeah, great. Look, that's really invaluable information. Thanks very much for joining us. So there you go, guys. Look, if you're buying, pre that 9th of May, was it? There's a few dramas if you're looking to claim depreciation. So something with a renovation could work in your favour, and if that's something you're interested in, we can definitely help you with that. So thanks for joining us, and thanks for your advice, and it's much appreciated.
Pleasure.
Thanks again.